Perfect. Well, thank you, everyone. Thank you, members of the committee. We are Ascend Capital Partners, and on behalf of Nora Wealth Solutions, we are here to offer an exciting opportunity for fund onboarding. So today, along with me, I have my team, Alex, Sung, and Danielle, and we are here amongst us with immense investment and development experience, and we'd love to share what we have in store. We start with the agenda. The executive summary is a high-level overview of what the problem statement is. We move down to the macro-level trends and then see how we glean from that to get to our fund-level analysis. We have the fund overview where we get deep into each of the funds and then finally present a matrix, which we then wrap it into our recommendations for us today. So I would like to hand it out to Sung now to present the executive summary as we walk through the presentation.
Thank you, Danae. Nora is looking to evaluate, enhance their 6240 portfolio with a private real estate investment. Our research, Our research suggests 10 to 15% allocation to these alternatives is optimal. Our goal today is to evaluate 3 non-traded REITs funds and make recommendations up to 2 for our platform. In order for this to do this effectively, we have anchored in our analysis in client-aligned objectives. These objectives include stable income, capital appreciation, diversification, manageable liquidity, and also overall platform fit. These objectives have guided every step in our evaluation. Before I go deeper into our evaluation, I'll start with the macroeconomic environment. We are entering into a period of monetary stability after 2 years of rapid tightening. The inflation rate has dropped down to 2 to 3% range, and the Fed has paused its rate hikes after tightening cycles. These 2 combinations reduces the valuation uncertainty and also support a stable underwriting. The SOFR curve has gradually declined towards the 3% range and is stabilizing slightly upwards through 2030. These will matter later in our SWOT analysis as it influences both the credit income and also refinancing conditions. The cap rate expectation also signals a stabilization. Most our survey respondents expect the cap rates to remain steady or compress slightly over the next few years, suggesting that the valuation reset of 2022 to 2024 largely behind us. Other economic indicators also point to a soft landing. Our GDP growth rate has been slowing down but stays positive. The job growth rate is modernizing in a healthy way. The SOFR curve, our sector analysis, it highlights a meaningful dispersion across the property sectors. Multifamily sector is past the supply peak. The vacancy rate is declining. The rent growth rate is normalizing in a 3 to 4% range, placing the multifamily sector in an early recovery state. The office sector, on the other hand, is facing a structural challenge. The vacancy rate is near 19% and is expected to stay elevated. This positions the office sector in a late cycle recessionary state. The industrial sector shows a strongest in the commercial property sectors. The vacancy rate has hiked up, but still stays below the historical norms, and also the rent growth rate is above the average, placing the industrial sector in a mid-cycle expansion state. Retail has shown a steady supply-constrained strength. The vacancy rate has dropped from 10% to 6% today, largely driven by the no new constructions over the past few years, putting it a income-oriented sector. These macro and trend analysis will establish the backdrop of our analysis for SWOT analysis and evaluation you'll see next.
Great. Thank you, Sung. So now we're going to take a deeper look into the three funds that we're going to be discussing today. So starting off here on this slide, the first fund on the left-hand side, we're going to be discussing RCREF, which is an open-ended real estate credit vehicle that primarily lends to industrial and multifamily assets. In the middle here, we have SC REIT, which is a closed-ended core plus equity fund that lends exclusively to industrial multifamily assets. And then additionally with having moderate leverage positions, including roughly 50% fund LTV. And then on the right-hand side here, we have NREC, which is a large open-ended equity fund with a long track record, strong specialization within certain specialized real estate sectors, alongside conservative leverage positions with roughly a 30% fund LTV. Great. So moving on here, we have our in-depth analysis on each fund. And before we dive in here, I want to clarify our definition in terms of our strengths and weaknesses. And we define this as specific fund-level considerations that we're looking at, whereas opportunities and threats are macro-level considerations. So starting with our strengths here, what we really like about SC REIT, that it really generates stable revenue generation through coupon-driven income, alongside a healthy net interest margin of 0.5 to 1.6%. However, something to note here is that there is limited upside by nature of it being a credit fund, and it misses out on that appreciation that you would see with some of the other equity funds. Moving on to some of the opportunities here, what we really like is, as Sung mentioned, there could be some cap rate compression in the future, and if that happens, it could cause higher collateral valuations. However, something to note here is that as RCREF has 100% lends at using floating debt, that a sharp interest rate decline could have a negative impact on total returns of the fund. Moving on here to SC REIT, what we really like about this fund is that it has meaningful upside potential through the investment in opportunistic profiles. However, something to note is that it does lack sector diversification since it is only invested in multifamily and industrial assets. Also, want to note that they have a lot of debt that's maturing within 12 months, about 40%, which is also a consideration. In terms of the key opportunities here, we really like the tailwinds from these two sectors that they're invested in terms of industrial and multifamily. However, something to note here is that they have a large amount of debt that's floating, so large SOFR increases could increase that interest expense. Finally here, we have NREC, and a few things we like about this fund is that it really has strong sector diversification with strong investment in these specialized assets. Additionally, it does have conservative leverage positions, again, like I said earlier, with a 30% fund LTV, which supports return stability. Something to note, however, in terms of some weaknesses, they do have some tenant vacancy risk in some assets, specifically with their retail and data center assets. Along with that, they do have some forward muted NOI growth expected in a few sectors, including office and self-storage. And in terms of the key opportunities here, something we really like is their debt profile, and they have really strong interest expense stability from having a 30% fund LTV, and on top of that, a 90% fixed rate and a 10% floating rate debt. And finally here, in terms of some of the key threats, we also see this being very sector specific in terms of elevated office vacancy alongside a decline in student housing occupancy. Great, now I'm gonna hand it off to Daniel to talk more about fund evaluation.
Alex, thank you very much for your analysis. Now, to determine the fund that best aligns with or for our client objectives, we designed a comparable and structured evaluation methodology to compare the funds throughout the same lens. Our goal here was to remove all types of noise, as well as create a consistent way to compare the funds throughout. So through the SWOT analysis that Alex just shared with us, we identified common themes. And with these themes, we created a standardized and weighted 6-pillar framework that would allow us to compare the funds side by side. Each of these pillars is supported by a list of quantitative and qualitative metrics, which would allow, and by comparing these metrics against the funds, we will be able to have an objective and apples-to-apples comparison between the funds. In addition, we also designed a proprietary scoring matrix where we would score each of the metrics on a score of 1 to 5 on the relative attractiveness to the market as well as to our client objectives. Now, here I would like to dive a little bit deeper into each of the 6 pillars I spoke about previously. So starting on the top left, we have the net return profile. Our investors' main goal is to achieve current income as well as some moderate long-term upside. And this is why the net return profile is the first pillar. Moving on to the sector exposure and cycle positioning, here we assess each of the funds' level of diversification across property types. For the third pillar, we have leverage, refinancing risk, and asset-specific risk, where we compare each of the funds' interest rate risk exposure, near-term refinancing risk, as well as any specific asset type vulnerabilities. Moving on to the top right of the slide, we have liquidity and redemption structures. Our clients are very sensitive to liquidity, and here we're assessing each of the funds' liquidity restrictions, as well as how they're transparent and clear they are for our clients to understand. Then for the fifth pillar, we have the fund track record, as well as their operational strength, where we compare each of the funds' performance through different cycles, as well as their operational discipline. And lastly, for our final pillar, we have suitability for wealth clients, and this pillar is a little bit different in the sense that it's a little more internally focused. As we're very early in our real estate AUM journey, we need easy to sell, low friction products in order to raise AUM as quickly as possible. And here we're comparing, can you go back? And here we're comparing how easy it is and simple to position each of the funds to the market. Moving on, now that we have each of our 6 pillars established, the next step was determining each of the metrics we will use to compare the funds. With this comparison of the metrics, we will be able to have a data-driven approach in order to compare the funds, even though they're very different in their strategy as well as their risk profile. So, as you can see from the presentation, we have several metrics for each pillar, but I would like to highlight some of them just to give you a representation of how we compare the metrics. So, starting in pillar 2, for example, we have sector mix, and here we analyzed and looked at the underlying assets of each of the funds to see their overall diversification, as well as determine if they had a big concentrations that would create the potential of downside risk. Next, for pillar 3, we looked at the weighted average maturity of each of the funds to see which ones had the longest runway compared to those that had the nearest term refinancing risk. As another example, for pillar 4, we looked at cash positions to see which of the funds will be able to meet any short-term cash needs, as well as any liquidity redemption requests. And lastly, for pillar 6, we compared the tax efficiency of the funds to see which would provide the best after-tax outcomes for our investors. Now we'd like to pass it on to Danae to speak about the fund assessment.
Fantastic. Well, thank you so much, Daniel. So diving deeper into our fund level assessment, we broke it down into 2 segments. We are looking at allocating weights at the pillar level, and at the metrics level, we are assigning scores at a simple scale of 1 to 5 to keep things simple and help us differentiate between these different 21 metrics that Daniel just spoke about. So to start off with, we are looking at empirical contributions that each of these pillars had on the overall fund performance. Starting with net returns, we are assigning it 30%, which is the maximum weight within our weighting factors. Net returns is the single most important driver of long-term performance for a fund. And so we wanted to assign it 30. 30 seemed perfect. Going down the list, we had sector exposure, and we also had leverage risk. Now, in our research, we realized that 70 to 90% of the variations or variance in the performance of a fund comes from sector exposure. So we assigned it 20%. Moving down, leverage, at 20%, more than 50% of the risk is attributed to leverage. So we assigned 20% to that. That seemed fit for it as well. Going down the list, we have 3 pillars, which are assigned 10% each. And these are implementation pillars, essentially. They don't really affect the return profile or the risk for the platform itself. And so we wanted to weigh them, but we weighed them at 10% since that seemed fit for the next 3 pillars. On the right, you see our scoring, a snapshot of our scoring matrix. We have the pillar on top and the metrics and the way we are scoring the metrics within a 1 to 5 scale. This really helped us directionally come up with a fund evaluation strategy and direct our final recommendations. So moving on to the next slide, we have the fund scorecard, and this is where the fun stuff lies. We have broken down the 6 pillars and attributed the winner for each of those pillars. And this is based on the scoring that we mentioned earlier. Very obviously, the net return profile for SC REIT was the maximum. It was a clear winner in that bucket. That's attributed to the 5% entry NAV, its exposure to value-add developments, and a sector exposure as well. Going down the list, we have NREC, and a common thread between different pillars for NREC was that its performance was best in like 4. So we have sector exposure, we have the fund track record, we have the vintage of the fund itself, and the suitability to clients. And so NREC performed really well in all of these based on its simple fee structure and how easily it could be onboarded, and its sector expertise and exposure to specialty sectors in this space as well. I want to point out that RCREF, with its 8% cash on hand, is extremely liquid and really attractive to us as we made this decision. And it has a transparent 10% in NAV redemption cycle as well. So aggregating all of this information, we came up with our final scorecard where we have 76% attributed to NREC. We have RCREF coming in second at 69% on a weighted basis. And then we have SC REIT at 64%, which is a clear laggard in this case. So this really drove our final recommendation. And drum rolls, we are finally recommending 2 big funds in our strategy. We are recommending RCREF and NREC. We want a combination of these, and it is extremely intentional, the decision behind this. We are thinking of a real estate sleeve which is balanced, conservative, and easily digestible for our high net worth individuals on our platform. We want to look at certain comparables between these funds and see advantages for these. So the combination worked really well when we wanted to assess a complementary return profile. We're looking at a stable NAV-based income from RCREF, and combining that with NREC and its potential upside in the private markets. That really helps us set up the complementary return profile. We're looking at liquidity structures for both of these, and we see that NREC's liquidity structure really helps the quarterly redemption cycles for RCREF. Going down the list, we have diversification of risks profile. So both of these, they have their own individual risks, but they are uncorrelated. And then finally, the tax structure. So depreciation, shielded income from NREC is really helpful for us to be extremely tax efficient when we compare that to the ordinary income from RCREF. So this is our final recommendation, but I want to caveat this recommendation by a few risks. We have listed down a few risks which we think might be the most plausible to have mitigants for in the future as well. Valuation risk, liquidity and redemption risk. We're looking at refinancing risk in the near term. And then finally, concentration risk for sector exposure, such as that offers by NREC. For valuation risk, public and private markets have a lag between their valuation cycles. And so to offset this, we think a mitigant could be to have extremely conservative cap rates in this case for valuation purposes. Looking down the list, we also have concentration risks, and we think that a mitigant in this space would be to have caps for sector exposure for different specialty sectors. I feel we think that this is extremely important so that we don't lay all our eggs in one basket. We diversify some of that concentration risk as well. Along with this, we have some alternative investment ideas as well, and I would like to bring back Daniel to speak about some of those and our thought process behind these.
Thank you very much. So through our analysis of the 3 funds, we also identified a couple of other strategies that we consider that NORA should evaluate in onboarding to the platform. The reason we chose these strategies is because they provide a different return profile, as well as a diversified real estate exposure to other types of strategies. For the first strategy that we identified is investing in a co-GP fund. We like this strategy as it would provide our investors with access to investing in the GP tranche, which would provide our investors with access to promote fees and reduce fees. In addition to that, they would also be able to have an additional layer of diversification. This will be through operational diversification of investing in many different sponsors. That said, there are risks associated with this strategy. There is greater manager selection risk, as well as that the GP equity is typically riskier than traditional LP equity. And then for the second strategy that we identified is co-investing in single assets. And this is a little bit more reserved for clients that have a higher risk appetite, as investing in a single asset would provide higher returns as well as potentials for reduced fees. That said, these assets are a little more illiquid, and in addition to that, there's also asset-specific risk in these assets. Well, thank you very much. This concludes our presentation. We're happy to answer any questions.